They sold you a lie. Your credit score isn't what gets you approved. It's a marketing tool designed to keep you chasing the wrong numbers, while you obsess over raising your score from 750 to 800. Real lenders are analyzing completely different data points. Last month, Sarah walked into a bank with an 820 credit score. Perfect payment history. 0 missed payments in 15 years. She was denied for a $300,000 mortgage. Meanwhile, David got approved with a 690 score. The credit score industry wants you focused on this single number. Because while you're distracted, optimizing your score, you're ignoring the variables that actually determine approval or rejection. The real underwriting process happens behind closed doors, using algorithms you've never heard of. If you're finding value in this, hit subscribe so you don't miss what's coming next. As we discussed, your credit score is theater. But here's what actually destroys dreams: income verification. The silent assassin that kills more loan applications than any credit score ever could. You could have an 800 credit score. Doesn't matter if your debt-to-income ratio is broken. Lenders don't care about your perfect payment history when your income can't support the debt. Here's the truth they won't tell you. Debt-to-income trumps credit score every single time. You think you're stating your income. Wrong. They're verifying everything. Tax returns, pay stubs, bank statements, employment verification. They see it all. Self-employed, freelancer, good luck. They want 2 years of consistent documented income. Now here's the rule that overrides everything. The 28-36 rule. 28% maximum for housing. 36% maximum for total debt. Your 800 credit score means nothing if you violate these ratios. Perfect credit. Denied loan. Because the math doesn't work. This is why income verification is the silent killer of loan applications. But there's more they're tracking that you don't know about. Your cash flow patterns. Building on what we covered, your credit score is just the appetizer. The main course? Your cash flow patterns. Every bank deposit, every withdrawal, every overdraft. Algorithms are reading your financial story like a book. Bank statement analysis software dissects 3 to 6 months of your financial behavior in seconds. They're calculating your average daily balance, tracking spending velocity, measuring income consistency. That overdraft from 2 months ago, it's not just a fee. It's a red flag screaming poor cash management. Multiple overdrafts signal chaos. Even one can trigger automatic denial algorithms. But here's what really matters. Deposit patterns. Regular income versus chaotic cash flows. Bi-weekly salary deposits at $3,000 each. That's predictable income. Algorithms love predictability. Irregular deposits of $500 here, $2,000 there. Red flags. Even if the total income is higher. Cash deposits raise immediate suspicion. Large irregular transfers trigger money laundering protocols. They're tracking seasonal patterns, growth trends, spending ratios to income. Your bank balance isn't just a number. It's a behavior profile being scored in real time. Every transaction tells a story about your financial discipline, consistency, and risk profile. But cash flow is just one piece. The hidden underwriting variables run much deeper than you think. Building on what we covered about cash flow, there's another layer of deception. While you obsess over your credit score, lenders are scoring variables you've never heard of. Employment stability isn't just about how long you've worked somewhere. It's about industry volatility, company size, and your role's elimination risk. A teacher with 5 years beats a tech worker with 10. Because algorithms predict your layoff probability before you do. Then there's geographic risk assessment. Your zip code carries a default probability score based on economic data you'll never see. Property taxes, unemployment rates, industry diversity. Your neighbor's foreclosure affects your approval more than your payment history. Property type hierarchies determine everything. Single-family homes rank highest, condos lower, investment properties lowest. Loan purpose matters more than loan amount. These hidden variables can override a perfect credit score instantly. While you obsess over your credit score, lenders are building a shadow profile of your true financial behavior. Every utility bill you pay, every social media post you make, every digital transaction you complete, they're watching, they're learning, they're scoring you on metrics you never knew existed. Your electricity bill isn't just about keeping the lights on anymore. Utility payment history tracking has become the new frontier of creditworthiness assessment. Late on your gas bill 3 months ago? They know. Consistently early on water payments? Also tracked. But utilities are just the beginning of this digital surveillance. Your social media posts are being analyzed for financial behavior patterns. Post about your vacation to Europe? Spending pattern noted. Share that new car purchase? Risk profile updated. Artificial intelligence scans your digital footprint 24/7. Your online shopping habits, subscription services, even your Netflix viewing patterns contribute to their algorithm. Digital footprint credit assessment tools are quietly revolutionizing lending decisions. They know your true financial stability before you even submit an application. Your credit score becomes irrelevant when they already know everything about your real spending behavior. Now that you know what lenders really see, it's time to game the actual system. Forget credit repair companies. They're optimizing the wrong metrics entirely. The real game starts with your bank account consistency patterns. Lenders want to see steady deposits hitting your account every single month. 3 months minimum. 6 months is the sweet spot they're really looking for. Your application timing becomes a strategic weapon when you understand cash flow cycles. Apply right after your strongest deposit months, not during seasonal income dips. Build the employment profile they actually want to see behind the scenes. Same employer payroll deposits create the stability story they're hunting for. Minimize account switching 6 months before any major application. Consistency beats optimization. Your debt-to-income calculation includes every monthly obligation they can verify electronically. Pay down recurring subscriptions and installment loans before they calculate your capacity. The system rewards those who understand what's actually being measured. Stop playing their credit score game. Start winning the real approval game instead. If this opened your eyes, smash that like button and subscribe for more.